Welcome back. Well, it is time for our special segment, Quarters Se Quarters Tak. Today we are talking about the FMCG space and Manglam is standing by to take us through all of the expectations. Manglam.
Well, so let's set the stage then by presenting the overall expectations for the FMCG sector in Q1FY24. We anticipate the return of volume growth. That will be the headline this time around, with mid-single digits volume growth projected for the entire industry. As the demand environment gradually recovers, we foresee a favorable scenario with regards to demand. Furthermore, the cooling off of inflation is expected to aid gross margins. Interestingly, companies are reinvesting their gross margin savings into advertising expenditures and price cuts to spur demand as well. Although summer products were impacted by unseasonal rains and moderate summer in the northern part of the country, the healthcare portfolio did see a massive, impressive growth as well on a favorable base and coming off the heavy COVID-related impacts as well. But shining the brightest in the FMCG landscape is the jewellery segment. We've seen 21% growth come for Titan and 34% for Kalyan as well. These companies hold a high hopes of recovery in the second half of this fiscal year post the monsoons. However, El Nino could be a bit of a risk. So let's talk about the updates that we've got so far for the first quarter. In the FMCG pack, we'll have D-Mart, which is about 18% revenue growth. Along with that, we've had Godrej Consumer as well, witness an expansion of their gross margins by about 800 to 1,000 points. Also, Marico, on the other hand, experienced a decline in their consolidated revenue, but their net profit has grown in double digits, whereas Dabur boasted a consolidated revenue growth of over 10%, but out there as well, net profit has been impacted. Titan, well, recorded a 21% jewelry growth in their jewelry business, whereas Kalyan as well, a prominent player in the Indian market, achieved an impressive growth of 34% in the Indian business itself. Now, in terms of what is expected in terms of margin expansion, for that you have to see how the raw material prices have declined as well. Palm oil has seen a 43% decline, palm fatty acid around 44%, copra itself has seen a 5% decline, Brent and Mentha, important marks, have seen a decline anywhere between 6 to 30% over last year. So as a result of which, we will see margin expansion for all the FMCG companies. What is it that the street is expecting in terms of revenue and EBITDA expansion from all the FMCG companies? Let's look at the next list, which comes in. What we're expecting in terms of growth for HUL, 8 to 9%, Britannia 10 to 12%, Asian Paints 6 to 8%. All these companies are likely to post their EBITDA growth higher than their revenue growth itself. 18 to 20% is the EBITDA growth that we're expecting for Asian Paints. Look at the other set of the companies as well that we have. We have Tata Consumer likely to show extremely strong revenue growth. We have, some other companies. Nestle is likely to lead the pack with an impressive growth of over 15 to 16% in the company's revenue, and we will see growth in Nestle's EBITDA as well. Going forward, let's keep an eye out on a bunch of other things that we'll be watching out for. For ITC in particular, we anticipate cigarette volume growth ranging anywhere between 9 to 10 odd %, and the street would eagerly await their commentary on the business structure of the company, as it holds significant implications for their future endeavors as well. Also, in terms of outperformers, don't lose sight of the smaller players, Bajaj Consumer and Jyoti Lab. For the last couple of quarters, they've been doing extremely well. And in terms of impact coming in from the summer products business, watch out for Imami as well as, Varun Beverages, because they may see a bit of a demand decline on account of, the unseasonal rains that we saw. Let's watch out for valuations then for the FMCG pack. They've never been cheap, and now they've not been cheaper either. In fact, ITC is trading above historic valuations, as is HUL, Nestle and Godrej Consumer. And a lot of the stocks are trading at fresh record highs, so that implies fresh record valuations as well.
All right, thanks a lot for that. Well, Abneesh Roy, the Executive Director at Nuvama Institutional Equities, joins us now to talk about what to expect. In fact, they have released a note where they talk about how their coverage universe revenues will grow just 5% in Q4 of this quarter, compared to 9.5% that their coverage universe has grown in Q4 of FY23. So there's definitely a slowdown on the top line. Abneesh, tell us a little bit about that. What are the key expectations this time around, both on the revenue front as well as margins? And where do you see the outperformance coming from in terms of individual stocks?
Sure, thanks. Firstly, on your question of the slowdown, I don't think it's a slowdown. See, revenue growth this time is looking optically more than the Q4 YOY growth because of two reasons. In ITC's case, because of the agri base being very high, there will be almost 40-50% dip in the agri business for ITC on YOY basis. Wheat exports was allowed last year. Currently, it is not allowed. So that is impacting the overall sector because ITC is a behemoth. Second is there are price cuts in soaps, detergent. So those are obviously also now anniversarizing. But if you see in terms of a volume growth, clearly things are turning a bit more positive because of two reasons. One is on the rural side, if you see Nielsen data also, now no category seems to be kind of declining in the rural India, which was not the case in the first half last year, when a lot of categories were seeing -5 to -9% kind of volume in terms of the rural demand. So that's positive. Second, of course, is companies are also giving back to the customer in terms of grammage addition and promotion. So that's also helping in terms of volume growth. If I see category-wise, food companies clearly doing better. Biscuits and noodles, for example, we have been calling out that they are gaining from the unorganized competition because of very high inflation in the unorganized part, while you get a biscuit and a noodle at a 5 rupee, 7 rupee kind of a pricing. So that is clearly helping them. Apart from that, we are also seeing that rest of the segments also the healthy growth is coming back, partly because of base effect. Definitely health and immunity portfolio seeing good recovery. We expect almost 8 to 10%, 11% growth in this part of portfolio for Dabur and Emami. Yes, the only weakness will be essentially in terms of the cooling and all those summer related portfolio in terms of cooling hair oil, talcum powder, beverages, ice creams. But those will be for a few companies only. Dabur, for example, in spite of weakness in this part of the beverage portfolio, we'll see a healthy double-digit kind of a sales growth because international also is doing really well. International business should do well for most of the companies, faster than the domestic growth.
Abneesh, hi, morning. So, okay, let me make it really, really simple because the trends are going to be complex. I think even the quarterly updates have told us that Marico is, far more conservative and was sounding a lot more somber on rural growth than, let's say, Dabur. So tell us this, in terms of the stocks under your coverage, which are the one or two which you think will post perhaps best-in-class earnings and where we may even see positive surprises?
Sure. So what is emerging here is wherever there has been a sharp deflation, for example, copra and edible oil, there has been a very sharp deflation. There is a regional competition which is coming back, and companies have also seen negative pricing which impacts the operating leverage. That's why Marico, Adani Wilmar kind of companies are seeing that challenge. In terms of companies which will outperform, clearly Godrej Consumer, Britannia, these are two companies which we expect strong numbers. Nestle also should be good. Dabur and HUL are kind of mid-tier, ITC also mid-tier, and Bajaj Consumer, as Mangalam also highlighted, that is one company in the small cap space which is really now finally coming back in terms of good double-digit EBITDA growth, good margin expansion, and good growth in the volumes also for Bajaj Consumer. So those would be the outperformers. In terms of underperformers, yes, Marico, Emami, and United Spirits, those will be in the lower tier in terms of various reasons, either because of deflation in their pricing in terms of the key products, or in terms of the summer demand, or United Spirits has sold off the part of the asset. But for United Spirits also, P&A should see almost 19 to 20% kind of a sales growth and almost 9 to 10% volume growth.
All right. And what about the recent hike that we saw in the Karnataka budget? What kind of impact will it have on United Spirits?
Sure. So it will have some impact. Essentially, what is happening is because of the freebies every state government is announcing in the run-up to elections and post they come to power. This is a key overhang which liquor industry will see this year because now Madhya Pradesh, Chhattisgarh, Rajasthan will also be there. Coming back to Karnataka, the hike seems to be quite sharp, 20% in the spirits and 10% in the beer. But for United Spirits, we need to see on the BIO and BII what's happening because that's imported. So that may or may not see too much of an impact. But on the overall industry, if I see for the domestic IMFL, there will be a negative volume impact because this is sharp pricing. And Karnataka government needs 52,000 crore for the subsidies which they have announced. And my sense is the other state elections also will see a similar kind of a strategy by the political party. So this remains an overhang. Going ahead, United Spirits margins will improve, gross and EBITDA margins gradually. But in Q1, you will see gross margins remaining under not much of a improvement, while other consumer companies are seeing good improvement in gross margins.
Also in your report, you write how United Spirits has sort of underperformed in the last 4 years, if you look at it, right? Is it largely, do you think this underperformance is something that will continue over the next couple of years with its peers, or do you think at some point things could change?
No, things are changing under the new MD. Clearly, we are seeing a lot of proactive action, a lot of new brands, a lot of higher aggression on the activation part, much better branding. So that's on the positive side. When you see the reported numbers in our report, that's getting impacted because company has sold around 11% of its portfolio, which is the lower end. So that is just because of that. If you see in the core part of the business, United Spirits in the past few quarters is doing really well. P&A, we are seeing double-digit 20%, 25% of YOY growth. Of course, the base was impacted to an extent by COVID, and then in the base, PIO also was impacted. So those are helping. But overall, under the current MD, we are seeing definitely good recovery in terms of market share also versus a Pernod. There was initially Pernod in the last 3-4 years has done better, but now under the new leadership, it seems that United Spirits is getting back market share. Radico also doing well, but I would say that these 2-3 players are the ones who will really see the gains. But definitely this year, because of the tax hikes, there is a impact on pricing, and volumes will also be impacted whenever that sharp price hike happens.
Okay, all right. Abneesh, thanks a lot for joining in. Appreciate your thoughts. We'll continue this discussion on the entire consumption space.